Just a quick disclaimer before I start, as I just need to do, I'm bound to do, obviously. This is for educational purposes only. I wouldn't take it as investment advice at the moment. And if you have any questions, we can take offline or speak to your associated investment advisor or someone who's a finance professional. I am, but I can't advise on this capacity because I don't know, obviously, everybody's individual assets and liabilities and their financial situations. But I hope this is helpful. We're going to start really basic and then just go into a couple of the investment products and how I feel a portfolio should be constructed. And please feel free, as I say, to ask any questions, or we can take some offline if you want to get into more granular detail, or there's something that I haven't covered in this presentation that you may want to know more about.
All right, we're going to start really quickly with a word of prayer, and then we'll begin with introductions and then jump straight in. Let's bow our heads wherever you are as we'll pray together. Heavenly Father, we thank you for the privilege of having knowledge and skills that we can share with each other and grow our understanding of different topics. Today we're talking about finances and investment. You ask us to be good stewards of our money, Lord. So we pray that as we learn this evening, that we'll be able to have open minds and retain information so that we can make changes in our own lives, Lord, for the better. We think we ask and pray in Jesus' name. Amen.
Amen.
All right. So we are going to get started. Jonathan's going to be presenting, and I'll just introduce him really quickly. So if you do want to take a video off, that's fine, because we're going to be presenting for a little while. So Jonathan Reid, I would call out his middle name, but we're not.
Yeah, let's not
We're not amongst that time. So Jonathan joined Goldman Sachs in 2019, based in London, and currently works in the UK third-party distribution team within the asset management area. He's responsible for co-managing the wealth management and advisory book of business with, just a 1.6 billion assets under his supervision. Before this, Jonathan worked in private wealth management, where he co-managed a team of 4 wealth management professionals, which covers new markets. So basically, I'm letting you know that he knows what he's talking about, and that's his area of work. So we can trust what he shares, but as new people are joining, just be aware that he's not giving advice in an official capacity. We're just sharing knowledge in the space. If you do want to get in contact with him afterwards with specific questions, then we'll provide his contact details afterwards for you to reach out to him. All right, that said, presentation ready.
Presentation ready.
Jump in.
And I presume that you can see it on the slides now.
Yeah.
Cool. Thank you so much for the wonderful introduction. It feels like I'm being introduced as like the heavyweight champion of the world. Honestly, it's not a big deal, guys. I've just tried to work as hard as I can and provide for the family. So let's get into it. So what is personal finance? We're going to start really simple. It's the process of planning and managing personal financial activities such as income generation, spending, saving, investing, and protection. Those are the 5 kind of areas that we're going to speak around today. And what I will do is I'll analyze the most common and important aspects of individual financial management. So as we have here, you have your 5 areas of personal finance, which is income, spending, saving, investing, and protection. So what is income? Any source of cash flow that an individual may receive that supports them or their family. And it's the starting point at which we'll look at the financial planning process. The common sources are salaries, bonuses, hourly wages, pensions, dividends. Dividends will come on to later on, but basically what a dividend is, it's a distribution of profits which are paid back to shareholders of a company or who invest in a single stock security. And all of these kind of sources of income will generate cash, which you can either use to spend, save or invest, and we'll kind of look at the differences and nuances between them on our roadmap. So what counts as spending? All types of expenses that an individual may kind of utilize their funds for, goods, services, and if you look at things like rent or your mortgage payments, tax, tithe, food, entertainment, travel, credit card payments, and it's looking at these spending habits and managing them, that is an important aspect of generating income. And most people have more control over their discretionary expenses than their income. and good spending habits are critical for good personal finance management. I say this because obviously any surplus from your assets and liabilities you can utilize to invest or to pay for things outside of your normal day-to-day spending. So it's very important that you keep a handle on your incomings and outgoings. And there's a spreadsheet that I utilize in this next slide. Pardon that it's in dollars, but if you look at the chart, it basically takes your income after taxes, so your salary, bonuses, any other income that you have from alternative investments, and then you'll have all of your expenses, as I say again, rent, groceries, entertainment, childcare, and this will obviously fluctuate dependent on your activity throughout the year. So if you're going to go on a big holiday or you have a big liability that you have to put money down for, it's going to obviously amount to either a surplus or deficit. Deficits being in the brackets, and the savings column, so the little orange bar there, assumes that if you start from month one with £5,000 in additional savings, and then throughout the year you'll have your incomings and your outgoings, and you can leverage the savings to obviously meet your liabilities.
A question, Jonathan. So how important is having a monthly budget? If I don't have one now, I kind of just get by. I could keep a check on my debits and my credits, etc. Like, can I get by? Is that okay for me to see change?
Personally, I would say it's very much dependent on your financial circumstances and where you are within, say, your life, your career. But I would definitely say that having it down on paper, having a chart or a spreadsheet where you can see in black and white exactly how much you're spending, definitely helps you to be more frugal, to help you look more holistically at your bank balance and what you have coming in and out. Because if you just like, oh, I check my account now, and I check it at the end of the month, and yeah, I'm okay, you may actually be missing out on a perfect opportunity of putting more money aside to invest, to allow more income to be generated. And it's very easy to get into a kind of poor financial situation if you're not monitoring your funds correctly. So I'd say to everyone, and it depends obviously on your source of income and your wealth, but even if you're a student to if you're on a 6-7 figure income, it's vital to track your investments. And then you can also start to analyze, well, why am I spending so much on groceries? Or where can I allocate spare cash which I'm wasting? Why are we going to the cinema? Or, why are we eating out 4 days out of 7 when we could maybe go to the shop and buy and save money that way? So again, it's something, it works for others, but I definitely would recommend keeping a very strict kind of oversight on your investments. And the easiest way to do it is through something like this, a spreadsheet. And I'm happy to share the equivalent of what I use after, because it definitely it was a game changer to use it. So saving, what counts as savings? So it's any kind of cash that's retained for future investing, spending, and as I said before, it's a surplus of what you earn through income and what you spend. The common forms of saving, and it's funny because I have a couple of more senior folk in my family where they will hold physical cash, and that is their savings, and it may be under a mattress, it may be in a cupboard, which I highly do not recommend, because so basically that's if you hold physical cash, it's not doing anything for you. You're not accruing even the basic level of interest. So it's better to put it in a vehicle whereby you're accruing some sort of interest, and through the power of compounding, you can actually see exponential growth. So then you'd have, say again, sorry?
What is compounding, sorry?
So compounding is the accumulation of, say if you had an interest rate of 2% on your savings account, and compounding means that every year the accrual or the increase in your position, it will compound, and it will again gradually increase, as like with the compounding effect. If you don't touch that investment, instead of having £100 and you get 10 for the year, let's say, then 110, you're going to get 10% of that, and then that will be a way of your income increasing at quite a rapid rate. If you look at your savings bank account, your ISA and JISA, so individual savings account, it's worth mentioning that for those who can, your tax-free allowance on an ISA, on an individual ISA, is £20,000. So that's any capital where you don't get any kind of tax at all. And for a JISA, which for those who have dependents or have children, so for myself, what I do with Aria is I've opened up a stock JISA for her so that I can invest in certain mutual funds and securities on her behalf, so that when she gets a little bit older, hopefully making, you know, the sound investment decisions that I have, she will have a little bit of a portfolio to get her started. And again, part of that is going to be tax-free. So any kind of gains up to £20,000, you're not going to pay any tax on. So always bear in mind that when you're going to invest, it's best to open ISA stock account, and you can hold both stock and cash, or just cash, dependent on obviously how you want to allocate your funds.
Helpful, thank you.
Cool. So this is just simply a simple diagram that talks about don't despise the small beginnings. As little as £5 a month within a certain tenure period can build up to a significant amount. And again, this doesn't include the compounding concept, which I spoke to you about before, whereby a percentage of interest would be added onto this. So these numbers would actually be significantly more. I'm going to stop there in terms of kind of savings and income, because it's pretty straightforward. And if anyone has any questions or queries, I'm happy to answer before we go on to the more investment advice.
Everyone's welcome either to raise their hand or just to unmute and ask the question, or ask it in the chat. I wondered what your thoughts on, Jonathan, for right now, while people are perhaps looking ahead and considering what the year looks like, seeing as we've got this whole lockdown situation and redundancies and furloughs. Is it still a good time to be saving, or what do you do?
So there's definitely, it's vital to have a certain allocation of your portfolio in cash. Mm-hmm. Cash is readily available, it's very liquid, and you can utilize that to certain things. But I would say in terms of the base rate is 10 bips or 0.1%. So you'll be hard pressed to find any kind of saving account which will give you more than 0.3% per annum. So because interest rates are so low, it's definitely worthwhile looking at alternative means of getting residual income and increasing obviously returns through investment, which is what I'll go to talk about. And I'll talk about kind of the comparisons between having a normal standard savings account and investing in, say, a mutual fund or a security or a bond.
Okay, so I guess the older generation, like you mentioned, they're quite focused on cash and kind of keeping cash around the house and kind of looking after that. Are you encouraging us not to keep cash?
Definitely don't keep cash, because cash gets eroded by inflation. Obviously inflation affects the kind of spending power of the money that you have, and year by year as inflation rises, it means that the purchasing power of cash decreases. Hence why you normally invest it in a vehicle to at least keep in line with inflation, and then surplus to that, it will be a gain on your investment. So cash is a no-go. Plus, in the unfortunate event of a house fire, or if the physical cash gets damaged, there's no kind of insurance policy to reclaim the funds. They'll be gone. Okay. At least within certain investments, you'll be covered by the Financial Services Compensation Scheme up to a certain value.
Okay. Before we move on to the investment then, a couple of questions. What did you mean by a portfolio? I guess we'll talk about that more on the investment side, but what do you mean by portfolio? And also, can you define inflation?
So inflation is literally the kind of the cost of purchasing. And as I say, this will be set by the Bank of England or the Fed, depending on what country you're in. And this will then affect your base rate, so the kind of rate that you borrow and sell at. So as inflation, if inflation means that your base rate will increase, so then the cost of purchasing then also goes up. So if you have rates that increase, but the monetary value stays the same, then you're going to get eroded inflation, which means that your money that was £10 last year is not going to still be worth £10 this year, because interest rates have increased. So that's what I mean by inflation. Okay. Therefore, you need to at least try and be in line with inflation. Hence why in normal cases, not some, your salary will increase slightly every year or when you get reviewed to stay in line with inflation, just because the cost of purchasing goods and services will increase over time.
So I guess like the cost of bread a year ago or 2 years ago was this amount, and now it's maybe 10% more. So
exactly. So if you look at a Freddo bar that we all used to love as children, that I remember once being 10 pence, I believe is now around 50 to 60p. Let's blame inflation. And sorry, in terms of portfolio, I'll go on to talk about our portfolio, but portfolio would be basically your combination of investment products that you hold, and this can consist of cash, it can consist of equity, fixed income, alternative investments, and I'll go into talk about that in further detail as we go along further in the presentation.
Okay. One question on cash before we move on to investments. There's a couple of questions that are more related to that. Oh, and one on credit cards. So the first question is, I've heard that having cash in the bank loses value due to inflation. So how do you go about protecting yourself against that decrease in value?
So that's a great question, and that's exactly what I'm going to go on to talk about in terms of putting your money to work, investing in actual investment products, whereby you can, even if you get an increment of 4% per annum, it's going to be a lot better than at the moment we're in a really low kind of interest rate environment. So people are finding it very difficult to even get a decent return on your standard savings account that you may have with your retail bank. So by putting that money to work into an investment product such as a mutual fund, such as an equity, you should be able to, if you diversify well, and I'll start to talk about diversification later on in the presentation, overall you should have an increase on your capital.
Amazing. And on credit cards, should we have them? Are they like, some parents be like, don't get one, don't have a credit card, it's bad. Other people got no credit.
Yeah, definitely. And as I remember mentioning before, I'll definitely talk about debt probably at a latter stage, but just to cover it now, having a credit card and obviously utilizing credit or a line of credit to pay off certain things, it can be effective and it can increase your credit score rating, but it's definitely down to how disciplined you are as an individual and how realistic you are with your financial circumstance that you can repay that debt. If you, as an individual, lack self-control or not managing your money well, then it's not something that I'd recommend. Again, this is very much dependent on your own financial situation, but I definitely will dispel the myth that all credit cards are bad and they're all evil, because a line of credit can be utilized to actually gain leverage and increase your capital in the long term. But it really has to be down to, as the individual, how well are they managing finances and how realistic are they with themselves that they're able to pay it off. Because line of credits are dangerous because you're actually utilizing money that is not yours. So you may see something that you'd like to purchase and think, oh, you know what, let me use my credit card and I'll pay it back. But then further on down the line, you get things like COVID, you get laid off from your workplace, a big expense may come up and then you have to then juggle the two. So it's definitely dependent on financial circumstance and strict risk management for sure. I like to say, and it's feasible for some and not for others, that when we go back to the risk, the budgeting slide, that over time, it's advisable to have at least 3 months worth of your outgoings as a capital buffer. Because if we look at, as I say, the macro environment and where we are today, unfortunately, because of furlough and people losing their jobs or being made redundant, if you have that capital buffer in place, then going forward, for at least 3 months, you have enough time to try and get back on your feet and utilize that kind of pot of money that you've put aside.
So by capital buffer, do you mean it's like a bit of a cushion, 3 months worth of pay, so that if something happens, you've got that saved?
That's it. And that's why I always say it's very important to always hold a certain percentage of cash for reasons such as that.
But not cash.
Not cash. cash within an account for sure.
Okay, let's go on to investments then.
Cool. So just around that, and then if we look at investments, we have here two charts which are showing your standard kind of savings account against a Vanguard ETF index fund. So ETF is basically like a collection or thousands of stocks in a single fund.
Mm-hmm.
And then the index will track performance of this fund, and you can invest in that, and that will provide you full diversification from that one investment. And over time, you can average around 7% per annum, dependent on how obviously the stocks within that basket perform.
So I
So
invest £10, and that £10 is then invested across.
that will be a very, very small fraction of the collective basket of securities that you invest in the ETF. So as you can see, you have a normal kind of US savings account. Again, this is US centric, apologies, whereby in the space of a decade, you've only increased your income by 1,685. If you put it in an ETF index fund, just using it as an example, we can go more into detail of the products later, you'd have doubled your investment and more. Same with on the right, even with kind of Corona in place, if you look at the FTSE 100, its 3-month performance was 7.27%. Therefore, meaning that over the long term, making these smart investments in comparison to just having your cash sitting in a current account where you're getting paid minimal interest, you can really capitalize on the opportunity and raise your capital through these kind of means. So that's kind of like a direct comparison of if you had the exact same amount of capital, the exact same time horizon, the differences are definitely very different.
But so some people would consider investing gambling.
Yeah. Okay.
What would your response to that be? Like, is it the same as me just going around to the local spa and getting a lottery ticket?
If I had a pound Melissa for every time I've been asked that question, I probably would be retired by now. So it's very simple. When you talk about gambling, if I go and I gamble on any kind of game within a casino or online, I am purely investing in chance. There's no kind of, I don't get anything back for it. There's no tangible kind of object that I hold. I invest in chance, and it's literally by luck if I win or I lose. Mm-hmm. If you look at the stock market or investing in general, you're going to make a calculated risk, and you're going to actually get a tangible product. So whether it's a stock, whether it's a bond, whether it's money markets, whether it's mutual fund, I have something to show for my investment, and it can go up or down. And as I say, nobody can predict the markets. But by investing my capital, you could say that we make, if we termed it as a gamble, we'd make gambles every day, right? Like the majority of people's pensions, if you pay into your pension along with your workplace matching your pension scheme, pensions invest in the market. That's how they will accrue their capital. And I'd say 99.9% of pensions are invested in a pension fund, whereby they will get capital and they'll distribute over to those who come into retirement. And so it's definitely not a gamble, because you can make a calculated risk. Mm-hmm. You can look at the information that is provided to you, and you can choose whether or not to invest. As I say, I have to be very clear. It doesn't mean that your investments are going to go right every time. Mm-hmm. And investing in the stock market is extremely risky. And I would say that you need to ensure that you educate yourself before making certain decisions. But it's also, at the same time, with higher risk will come greater reward. And again, that can be dependent on your risk profile, which we can go through in a bit, because some people are quite risk averse, some people aren't so much. Some people have time on their side because they're like younger or dependent on where they are in their life stage. So those who may be looking at retirement, looking to kind of invest for the future, those are all factors that play into how much tolerance you have within the market to ride, obviously, the turbulence of the ups and downs that your investments may go through.
Okay, let's press on with the definitions.
Sure. So as an investment, it's a purchase of assets that are hopefully supposed to generate a rate of return where you'll receive your money back that's originally invested and more. It carries risk, as mentioned before, and not all assets will produce a positive rate of return. And that's where we will see the relationship of risk and return. higher the risk, the greater the reward. The lower the risk, the lower the reward. And these kind of look at stocks, which we'll go on to talk about, bonds, mutual funds, real estate, commodities, FX. There are also alternative investments such as private equity, hedge funds. For the more sophisticated investor, which I'm happy to go through, they are quite complex and they're definitely not recommended for a usual retail investor. But there are other things out there, even things like art or people that purchase wine or other commodities can be classed as investments.
Okay.
So this is one thing that I'd definitely say for those that are interested in kind of investing. What is your investment objective? What's your kind of risk tolerance, your time horizon? How much are you willing to actually invest? How much are you willing to put in? And what is your monthly commitment? You don't always have to have a monthly commitment towards your investments, but I'd say that, it's advisable as you can top up your investments. And as I say, the more that you can siphon from your surplus, the more return you're likely to get in the long term.
When you talk about risk tolerance, are there any products that assure your investment? So for example, if I invested in Tesla and Tesla just dropped off the market tomorrow, is there anything that can kind of shore up my investment or give me a guarantee of some level, or is it just completely?
I would say that definitely the safest investments are like government bonds, like your gilts, because they're backed by the government. They're very, very low risk, and it's very, very unlikely that as a government body, they're ever going to default. So if you look at fixed income, it will be a government issuing debt to then repay back at a certain time, and you'll have a coupon attached to the bond, which will be your interest rate paid over a certain amount of years. And because they're government backed, they are classed as your very safe, risk averse investments. And in the history of, especially within the UK, I'm not aware of, as I say, the UK government defaulting, even in the lower or the pandemics that we're going through now.
So bonds are the safest types of investments.
I would say so.
But
government bonds, government-backed bonds,
backed.
Yes,
Oh,
because you also get corporate bonds. So you'll also get companies that want to raise finances through issuing debt, which I'll go on to talk about when we touch on bonds. But I'd definitely say that fixed income is one of the safest investments that you can make, for sure.
But the assurance, so there's no insurance that you can get for investment into a stock or share. Like if they crash, then they crash. There's nothing not an insurance you can purchase to kind of mitigate that. No.
So there's certain kind of stipulations. As say, you've got the financial compensation service scheme, whereby sometimes people are coerced into investments, or there may be foul play involved.
Right.
A manager may not have disclosed all of the information to an investor, whereby you can make a certain claim if performance is especially very bad. That will go through that body, and then they would assess the situation. And there are moments where people will get some of their capital back. But in terms of your traditional vanilla investment products, you make that calculated decision on the fact that if the price goes up, it goes up, and you will reap a reward from it. And if it doesn't, unfortunately, you'll make a loss.
Thank you.
No problem. So what are stocks? So stocks, shares, equities, securities, they're all the same thing. And this is basically when you own a physical part of a stock. When stocks go public, they're listed on an exchange. So within the UK, they will normally go on the London Stock Exchange. And in order for them to raise capital to fund whatever activities they would like to do, they will normally issue to shareholders a unit or a portion of their company so that they can do certain specific things. And as a reward for that, you will then hopefully partake in the profits or the activities of the company. So you become a stockholder, and as I say, stocks, shares, equity, and this consists of exchanges where you can buy and sell individual shares of a company at will. And I say some of the benefits is that you have a claim on the asset, so you get dividends and capital gains. So dividends are, as I said before, a distribution of the profit that a company may receive or kind of accrue throughout the year. Capital gains is simply the accrual if the increase in their share price, then from a growth perspective, if you buy at 10 and the share price goes to 20, at that moment in time, your holding is worth double what you paid for it.
Did they give you that 10, or do you then have to sell your stock in order to get that 10?
So you have to sell your stock in order to redeem that income, for sure. But when you're holding your stock, the dividends will carry on to be distributed as long as you hold the stock for. And from a liquidity perspective, they're quite easy, dependent on the stock or the company involved. Some shares are easier to sell than others, dependent on how popular they are, how well they are doing. But obviously the risks are loss of capital. And if the stock does go into liquidation, if you're in a normal shareholder, because you have different types of shareholding, you have like normal shareholder, you have a preference shareholder, and then you have like your creditors. If the company does wind down, as a normal shareholder, you'd be bottom of that list. And then there's the normal brokerage fees that you'd pay upon purchase or sale of the investment. So you'll get a small charge for that, and that's how obviously the brokers will make their money.
In terms of brokers, again, everyone feel free to ask questions in the chat, and I'll ask them at the end in our question and answer session. But in terms of brokers, there's all kinds of ways to interact with brokers these days, rather than me actually physically going down to a broker that can get an app. Are there apps that you would recommend? Would you recommend that kind of more independent way of engaging with the stock market?
I'll touch on that later on in terms of access to the investments. As we are in this new age of technology, there's even certain firms that will provide robo advice, so you're not even speaking to a human and they're advising you on certain investments, which is pretty cool. But dependent on the amount of capital, some people feel a lot more sure to speaking to a physical person and discussing, their own financial outlay and their kind of views on the market. There are a few brokerages which I'll definitely recommend later on in the presentation, just from a fee perspective, in terms of it's maybe those that I've utilized myself, whereby you get a wide access to some of these investment products.
Okay, thanks.
So bonds, as we mentioned earlier, they're fixed income securities issued by corporations and governments to raise capital. So the bond issuer will borrow capital from a bondholder, so investors, which is us, and then make fixed payments to them at a fixed or variable interest rate for a specific period. So that fixed or variable interest rate will be the coupon attached to the bond. And then at the end of the term, you'd get your initial investment back. So this is consistent income. It is very stable and it has certain tax advantages. Interest rate risk, obviously, in terms of bonds or fixed income, they have an inverse relationship to interest rates. Credit risk, if you do in a situation when you have corporate bonds, they will get graded according to how they're rated by certain kind of governing bodies. So you have like Moody's, Standard & Poor, Fitch, and they will assess the balance sheet of the company and they'll look at how likely they are to default, and they'll get a grading. And then dependent on their grading, so you'll have investment grade, and then you'll have below investment grade or par investment grade, which will be more your high yield corporate bonds, because they will have a higher rate of interest because you're taking on that high risk, right? Yeah. And just a kind of example, if you bought like a £1,000 treasury or a gilt at 3% for 2030, it means, and gilts, so UK gilts pay their interest semi-annually. So every 6 months you'll get the coupon payment. So say if it's 6%, you get 3% in 6 months, and then the other 3% for the end of the year. For that 3%, you would get the £30 and then another £30 until 2030, where you'd get your initial £1,000 back. And because it's government backed, that's why it's looked at safe. You also have index-linked gilts, which will they follow the RPI, so the representative of the retail price index. So the retail price index it's a sample of retail goods and services and how much they cost at the time. Mm-hmm. And by that, you kind of can ride the wave of inflation, because the RPI will also behave the same way in which interest rates will go up and down. So definitely quite a safe investment. When we look at it from a government-backed perspective, when you look at like your corporate bonds, they're slightly more risky because it depends on the balance sheet of the company and how their credit rating is scored.
So why would a company have bonds rather than stocks? So for example, I don't know, a new organization like, not new anymore, but like Monzo, say, when Monzo popped up, they would have had shares that you could buy, but not bonds.
So some companies may not want to dilute in terms of, if you offer more shares out, you may dilute the shareholding of the stock. By issuing a debt security, you kind of avoid diluting your share price. So a lot of companies will look at it from that way, and it's just an alternative way of raising debt, or issuing debt to raise capital so that they can finance whatever endeavors they have going forward.
Okay, what's next?
So mutual funds. Mutual funds is kind of like your one-stop shop in terms of, if you don't want to invest in your single stock securities, it's a pool of collective investors, and it will invest in, so if you look at money markets, a money market fund it will invest in short-term debt. So when we talked about corporate bonds and UK gilts, a lot of the time they're more long-term. If you look at money markets and if you look at like T-bills, they can range from 30 to 90 days. And you have commercial paper, certificates of deposit, and they will help with your short-term financing. So if a company just needs an injection of cash, they may utilize a money market option. Fixed income, as it says on the tin, it's a group of pooled investments that are investing in your bonds. Equity, same kind of thing, investing in stocks. Balanced funds, that will be a balance of your fixed income, your stocks. You may look at derivatives, and that will kind of, with the balance, it gives you income and it may offer you growth as well. And then your index funds, as I say, will invest in index trackers. Specialty funds, they may invest in kind of like one kind of constituent, so it'd be like one energy company, or they'll only invest in natural gas. They're a lot more rare and they're not as popular in the kind of industry. Some of the kind of pros behind investing in a mutual fund management, you're going to have a portfolio manager that are picking the stocks or the bonds for you, and you get the kind of investment diversification. So instead of me just investing in Apple, if it's a mutual fund that's looking at tech, it may invest, it will have a certain weighting: Apple, Amazon, Netflix, Microsoft. You'll have exposure to all of those securities within that one fund. And then liquidity, they're very easy to kind of buy and sell. In terms of risks, management fees are definitely a lot higher within a mutual fund. Loss of control, because you don't have any kind of say around where the funds are allocated. You leave that to the fund itself. And if the fund performs badly, then you can obviously see a drawdown or decrease in your capital.
In a mutual fund, you're getting an average of the stocks and shares, or the bonds, or the equity.
So it will,
the return, I mean, it's an average of the output of the fund as a whole, rather than per organization. Okay.
Correct. Real estate, I saw that. I think Marvin was on last week. He's definitely probably more qualified to speak about this than myself, but just stating the obvious, it's where you can purchase land, residential, commercial, industrial, and it gives you the rights and the title to the ownership of land, and dependent on what your investment objective is, you can leverage this accordingly. Great thing, and this is probably an investment that a lot of our parents, grandparents are more comfortable with, in terms of just getting yourself on a property ladder or building a portfolio of real estate. It's a tangible product. You can see it. You're in a house, you own the house, it's there. It's effective hedge against inflation, because house prices will obviously move in the same direction as interest rates. And it's a form of additional income. So if you have more than one property, you can gain residual income by renting it out. You can gain capital by, say, if you do it up and you sell it for more than you bought it for. Some of the risks or the drawbacks are that it requires quite a hefty investment. in the first place, dependent on obviously where you're buying and what you're trying to invest in. And liquidity risk. So when I talk about liquidity, liquidity is basically a measure of how easy something is to buy or sell. And obviously, in comparison to, say, a mutual fund where I can go online and click sell within trading hours, with a property, you have to list it or gauge interest of those who want to buy the property, and it can take quite a long time. And again, as I say, high initial expense, stamp duty, legal fees, etc. They can be barriers to entry. And as some of the younger generation know, it's not as easy to acquire, dependent on your financial circumstances.
Yeah, and I guess the rate of return as well for properties that are on sale now versus when you made your £3,000 investment in 1960.
Mate,
Um,
I tell
yeah,
you what, some of our the people before us were living the dream. But again, we argue that it was all relative, right? So again, back then, 3,000 was a significant amount of money, but definitely not. It doesn't equate to the same value of what we pay for houses now. So they were definitely an advantage back in that time.
all right.
What else can I invest in? So a commodity, it's a great hedge in times such as these. So if you follow any of the markets, kind of like gold and silver are rallied at this time. So again, you can invest in kind of like your metals, gold and silver, energy, crude oil. Earlier in the year, there was a glut. So a glut was like an oversupply due to the fact that the pandemic was occurring. So oil plummeted dramatically. Then you have like your livestock, your pork bellies, live cattle, agriculture, which is kind of like your soybeans, wheat, rice, coffee, and these can also provide diversification. And I'd say the only thing as a risk there is they can be quite risky. Some people utilize them in a forward or future perspective. So I could say, hey, I'm going to enter a contract where I feel that wheat is going to increase. So let me lock in a price now, and then hopefully it increases. Therefore, or if it decreases when you buy it at a cheaper rate. Or if you sell it at a profit. Or you can have an option. So a commodity option is where you can enter into agreement where you don't have the obligation, but you have the option to buy or sell the product, and you pay a premium for that. And obviously, if it doesn't work out in your favor, you just let the option expire and you lose your premium, or you'd exercise your right if you was in the money. So again,
where does this investment happen? So we talked about apps, brokers for stocks and bonds. If I wanted to invest in gold, am I going to find a gold seller and purchase it?
Yes, you can go on a brokerage and that you can trade them, as I say, through ETFs or through exchanges. So the Chicago Mercantile Exchange is one exchange that a lot of companies use. Obviously, back in the day, you had like these rings where people would physically be in the pit, they called it, as the game pit. That's where it comes from, because a lot of the time you're shouting that you have a price for this, but a lot of it now you can do electronically. In some cases, they're still physically delivered. It just depends on what commodity you're investing in.
Okay. So if I wanted to buy gold, is someone going to deliver it to my house? What would
No,
that look like?
no. So you would invest in the underlier, so the value of gold, and then as that accrues up or down, you can, as I say, enter into a future contract or an ETF, or you can actually purchase gold as a physical commodity, and then if it appreciates in value, you can take it to somebody who invests in gold, like a jeweler, etc., and get a return that way. So there's various different ways that you can invest in commodities.
Good to know.
Forex, FX. So this is very popular with some of the younger people. It's super easy to get into, and it's literally where you trade currencies. It's a huge market with, again, $1 trillion exchanging different institution hands every day. It's not centralized, it's over the counter. And it's pretty much, in layman's terms, for those people that go on holiday, they will execute an FX trade, or they'll be an FX agreement. If I go to Jamaica and I want to change my sterling into Jamaican dollars, I will get a rate, and I will get a certain amount of Jamaican dollars for the pound that I hold. In simple terms, Forex trading is about people buying and selling currency pairs and hoping that you have your base and your quote currency. And if you are going long or you're buying the currency, you hope that the base will accrue or increase compared to the quote. And if you're shorting it or if you're selling it, you hope that it decreases. So for an example, I have a close colleague who made a substantial amount of money because he shorted the pound USD. So he thought it was going to go down. Around Brexit, when we voted no, the pound plummeted and he made a profit because he was selling against the pound. So he was backing the pound to decrease in value. The same would be if you backed it to go up.
Is that not betting?
Is that not betting?
Mm.
I wouldn't say it's betting though, because one, you're making a calculated risk whether a currency pair is going to go up or down. When you invest in the currency pair, you can see your investment tangibly. And then in terms of risk management, you can set your stop loss. It's not just you've made a whim and you're thinking, yeah, it's going to, normally there'll be some sort of fundamental or technical analysis that goes into exchanging currencies, and you're actually getting something for your investment.
So if I predict that the pound's going to go down, yeah, I'm not getting an asset, right? In that respect.
No, so you buy a lot or you sell a lot of that currency, and then as it increases or decreases, then the spread, that's where you would, in the way that if the market goes for you or against you, that's where the increment of your investment would be paid back. But again, because you can leverage, you can definitely lose a substantial amount of money. So a lot of people definitely would advise against utilizing leverage. Leverage is, if I was trading 1 to 10, I could accentuate my holding by 10 times, but it also means that if I lost, I could lose my position by 10 times, therefore putting me into a deficit.
Okay. Yeah, the question was, does someone lose if I win? I guess
yes, 100%. With Forex, you always have somebody on the other side of the trade. So whoever's gone long on the pound, somebody would have taken the opposite side of that trade. So there's always going to be a winner and loser in foreign exchange, unfortunately, but that's just the way that the market goes. They can't all be winners.
Yeah. All right. Would you recommend it? So if we were kind of, I don't know, ranking the risk level of some of these investment options, so you've got stocks and shares, you've got bonds, you've got Forex.
Yeah.
What does that look like in terms of risk?
Forex is definitely extremely risky because it's really volatile. So if you think about the kind of sporadic movement of certain pairs are more volatile than others. So if you're trading the pound against USD or the Aussie dollar against Japanese yen, so you'll always have a base pair and a quote pair, and then that's where you'll get the exchange rate for a bid and an offer. Okay. Because it's so volatile, I wouldn't say that it's an investment that I would go into just lightheartedly. The statistics are that 96, especially if you're talking about yourself and me, retail investors, around 96% of investors within the FX market will use money, and only around the 3 to 4 percentile consistently make money. So
percentage, right?
Yeah, it takes time and dedication to really research currency pairs. The beauty about it though is because there are only a select number of pairs, if you can really get to grasp with how they correlate with each other, and if you keep an eye on how the markets are, the news around that pair, so whether it's the political instability, the export and the imports of that country, once you have that down, it's a lot easier to trade than the thousands of stocks that are out there, whereby it's better to invest once you've done your fundamental and technical research. So for some of my FX traders out there, that's kind of their advantage, is saying, well, we only have to learn a specific set of pairs and how they interact with each other. And once they have, again, their risk strategy in place, a lot of them will produce consistent profits.
Thank you. I'll let you keep going because I'm running out of time.
Yeah, sure. I'll whiz through this quickly. So how do I buy these financial assets? So as I said to you before, when you're talking about other apps or their brokers, you have online brokers, Halifax, iWeb, the Share Center. Very cheap, execution only. So by execution only, it means that you as an investor make the investment decision, and then whatever you instruct, the trade is executed. Cons are sometimes you get limited advice, right? So you're on your own. You make the investments based upon your own situational judgment, and sometimes they don't offer the wider scope of investment products. If you look at like fund supermarkets, it's like Hargreaves Lansdown, massive broker, Fidelity, AXA, massive choice of products within different investment instruments. And there's also advisory services available. So you have like execution only, where it's just literally no advice. You do the transaction yourself. Advisory is where you may go to someone for advice and they'll let you know, okay, these are my thoughts, take this with a caveat, and then make your investment decision. Then you have discretionary, where you're like, take my money, you guys make the investment decisions for me, I give you full reins to invest on my behalf. Again, with those services, there can be costs, so they can be more expensive. And then dependent on your position, like financially, you can go to a private bank, IFA, investment management firm, investment bank, where they will obviously provide certain services for you at a fee.
Okay.
So portfolio construction, somebody asked about this earlier on. So this is literally understanding how your different asset classes, funds and weightings impact each other. The performance of risk, and be looking at like investment objectives. So how I look at a portfolio, again, you can see from the slide, 62% in stocks, 25% in bonds. You've got commodities there, real estate and cash. Now, dependent on my own financial circumstance and my own goals, you can readjust those weightings accordingly. But this is how all of the kind of investment products I have come together. You want to create something called diversification, so where your assets aren't all correlated or going in the same direction, because as some stocks or if some investment products increase or perform well, some may falter, and you want to kind of get that balance whereby your whole portfolio isn't just affected by one like occurrence in the market, or if the market moves against you.
What about the timing of that diversification? So we're looking at kind of short-term investments and as well as long-term investments within that portfolio. Was it kind of wise to have everything in the future?
So you'll have your short-term investments in there and your long-term investments, and then if you liquidate your position with your short term, which you're going to do much sooner, you may then reassess and look at your portfolio and think, okay, I've liquidated that asset. Is my portfolio still balanced, or do I need to say sorry?
By liquidate, you mean?
So by liquidate, I mean sell. So when I liquidate my position or I sell my position, do I then have to move around my investments to make up for that sale? So it's all about investment horizons and looking at your financial goals. I'd say that you need to always consider the overall market outlook. So a lot of people would have shifted their assets during COVID, more of a fixed income stance. They may have come out of equities. A lot of people are asking now, well, we're in a global recession. Is now the right time to start investing in equities again? And it's definitely just down to certain sectors are going to be doing well during this time. So if you look at like consumer, healthcare, technology, those are some of the winners. But then you have like certain others, like airlines, for example, have taken a real hit within this kind of crisis, right? So it's about doing an analysis on each stock, looking at how strong their balance sheet is, looking at if you're going for a V-shaped recovery. So a V-shaped is literally, as what I'm showing you here, a strong rebound, or if it's more of a U-shaped, whereby over time we're looking at more recovery end of Q3. Again, nobody knows for certain. We have all these economists that predict this and that, but I would say that if you have a time horizon over 18 months, then it's starting to look at certain equities again, because they may be valued as quite cheap at the moment because of the decrease in price throughout Q1 of this year.
Q1 and Q3. Okay.
Now, this one, sorry.
Just one question, which was on so someone completely new in this topic area. What am I looking at for the return on investment? So short term, I could, if I did a trade now and it was just solely me involved in that process on an Apple or something, and I traded, I don't know, and I bought an Apple stock, sold it, and there was a big increase. That's like a really quick investment, and I could get paid that same day, right? but then there's a long-term investment as well. So you've got kind of the short-term, medium-term, long-term types of investment.
Correct.
Okay.
So is that a question? So you're saying that, like, in terms of short term, I'd say first of all, definitely do some research before just thinking, oh, I'm going to just invest and then I'm going to sell. There'll be certain times where you want to sell, or where you want to top up or increase your allocation. So when I say allocation, increase your holding in a certain product. And then when you're looking at more your long-term investments are definitely your fixed income products. So your bonds typically are 5, 10, 15 years. From an equity perspective, that's down to whether you feel to sell out of them. But normally people hold them over the long term to kind of weather the storm of turbulent markets, dependent of whether it's emerging markets where we're looking at kind of like your China, India, Asia, or your more developed markets like your US equity. If you invest in the S&P 500, those are the top 500 companies within the US. So it's all dependent on, I feel, your own investment horizon and how much capital you feel you can put towards those investments, for sure. I'll quickly touch on protection. Again, I'm not an expert when it comes to protection at all. These are quite explanatory. If you look at like life insurance, please think about life insurance methodically, because again, if you have dependents, if you don't, it's always good to leave your loved ones, if the unfortunate circumstance was to happen, in a comfortable financial situation as possible. Again, with health insurance, there'll be certain policies that will be provided by your organization if you're working. If not, there are certain, as I say, you can go on a lot of these comparison websites to see which ones will work for you from a price perspective. And then quickly on estate planning, just it's vital that you, when you have assets and you have a portfolio, think about how they'll be distributed. Again, in the unfortunate circumstance of death, there's a 325,000 tax allowance, inheritance tax allowance on any assets. Anything above that will be taxed at 40%. Ways around this, and again, this is not advice, it's for educational purposes, is you can gift to, say, your loved ones, your spouse, your children, and over a certain amount, so if it's over 7 years, it doesn't get taken into consideration of assets to be looked at once or upon death. So that's definitely one thing to consider. But again, speak to a kind of advisor in regards to that. And when it comes to wrapping up, assessment, so we've kind of covered looking at your financial kind of outlook, your goals, what do you need to invest for, how much money are you thinking of putting down, how much do you want to get out, plan development. So then think about how you're going to lay out or execute this plan, what kind of broker you're going to use, what investments you're going to kind of look at. Execution, which is actually the act of trading itself, and then monitoring and reassessment, which is basically always ensuring that you have eyes on your portfolio and you can react accordingly to the certain cycles of the market, and rebalancing as you see fit. But I'd say that within this part of the economy, there's been a lot of rebalance and government fiscal and monetary stimulus. And I feel that over the next 12 months, we will kind of see whether we get a second wave or not. Really look at healthcare. Obviously, the vaccine, the trials, there was a positive immune response with the Oxford and AstraZeneca project that's going on, that got released today. And then I'll just say, always, it takes 2 seconds to kind of, we have the internet at our disposal. So you don't have to be within the industry like myself to become financially savvy. There are many tools which I'm happy to share with those that are interested after this call. There are a lot of books that you can read. So you have like The Intelligent Investor, Ben Graham, Rich Dad, Poor Dad, which is a very popular book that a lot of people have heard of. The Rule by Larry Heatt, Mastering the Market Cycle by Howard. I can't remember his last name, but these are tools out there where you can really start to invest in yourself. And it's within this kind of market and the conditions, as individuals, if we can make these investments and increase capital, we will then have the resources to implement, whether it be things for the community, whether it be things for those that are in church, whether it be in your own life. I wanted to dispel the myth that it's a scary, dangerous place. I encourage people to go out and do research for themselves. And again, happy to do another session or follow up with people that want to get into the more granular aspects of investment, because I know that this is quite high level, but it's definitely something to consider. And I just wish that we all consider or continue to be prosperous and, wealth.
Good health and wealth. Thanks,
I
Jonathan.
hope that was helpful.
It was, for me at least, and people in the comments have got lots of questions. It seems like they're engaging. So your dad asked, what about Bitcoin?
Oh, mate. And if anyone was going to ask that question, it would be my dad. With Bitcoin, if we look at cryptocurrencies as a whole, it's still fairly new, and there have been exponential gains if you look at, say, the past 7 to 8 years of when Bitcoin got introduced to what it's valued at today. But one, I don't know that much about it because it's not really part of our investment process within the field that I work. And it's still not really a regulated investment product. So you get instances where a group of investors will come together and they'll just pump and dump. So when I say pump and dump, they'll heavily inflate the price and then just sell off, obviously benefiting from the increase. But then to the casual investors that are putting in our liquid 2p here and there are the ones that lose out with that. But it's definitely, because it's digital currency, obviously with the whole blockchain technology, it's something to keep in mind, and it's something that I've keep in my eye on, but I'm not qualified to really advise on whether it's a great investment or not. So as far as I'm concerned, for now, I would stay away from cryptocurrency unless you feel well versed or have enough information to make a based decision on that.
And if I wanted to get financial advice, like, can I rock up to Goldman Sachs with £150 for an investment? Like, will you provide me with advice?
Unfortunately not. So within most investment banks, within private and asset wealth, there'll be a certain minimum amount of liquid capital. So by liquid capital, it's a tangible asset, so cash in the bank, freely available, of 7 figures above. But if you wanted,
like before 0.0.
But if you wanted advice, there's definitely like independent financial advice firms. There's certain smaller wealth intermediary firms, and again, you have like your robo advice and your online brokers that will offer discretionary and advisory services. And then you have like your retail banks, so like, as I say, your HSBCs, your Santanders. They will have some sort of premier banking division where you can ask for a relationship manager or private banker that may be able to walk you through some of the things that we spoke about today. But I'd say that for a lot of investment, there will be a minimum amount of capital which you need to put to work. But apart from getting advice, you have financial professionals around you, like myself, who say happy to speak to anyone on a one-to-one basis, but it's just not appropriate within this forum because everyone has differing, financial outcomes and objectives that they have in mind.
And how can people get in touch with you if they do want to reach out?
I'd say the easiest way to contact me, unless you know me personally, is just to drop me a message on LinkedIn. My name is Jonathan Reid, Reid. And happy, or drop me an email at Reid, so that's Romeo Echo Indigo Juliet Sierra Romeo Echo Indigo Delta. Wow.
DJSR, right?
DJSR at gmail.com. And I'm happy to kind of connect to people on there. Obviously, I will put my phone number in this forum, but happy, as I say, to discuss further. I know this has been very kind of high level, but I'm happy to get into the nitty-gritty if people feel to do so.
Yeah, one more question I think we have time for, unless someone wants to add anything else. But would you say it's easier to diversify with funds rather than individually investing in companies? Like, if you're just getting started, would you recommend
For sure. So if you're just getting started, I'd definitely recommend like a tracker fund, or as I say, a mutual fund. So a tracker fund will track an index. So a FTSE 100 tracker will basically replicate the same holdings of the stock within the FTSE 100, and you invest in that one fund, and therefore you'll get exposure to the FTSE 100 as a whole. So you get the instant diversification. So if you're a newbie and you're just starting out, apart from obviously your bonds, if you want to have a taste of the equity market, I'd definitely recommend like a S&P 500 index tracker fund, or a US equity fund, something to just get you started, because you already then have access to all of those different companies. If you're just like, hey, I'm going to put £100 on Apple, there's no diversification whatsoever. If the Apple share price plummets tomorrow, so with your investment. If you're in a fund whereby Apple is part of the index, Apple share price might go down, but there'll be another stock in there that will have obviously a negative correlation to keep your investment kind of as safe or balanced as possible. So I'd definitely kind of recommend looking at your index tracker funds as a starting point and go from there.
And if I wanted to buy a stock, is it possible? So I think if I was to put £150, let's say, in NatWest as their entity, am I likely to be able to buy a whole stock to myself for £150?
It depends what the stock is valued at the time. So different stocks will be valued at different prices. For example, so Warren Buffett, his company Berkshire Hathaway, one of the most expensive stocks on the market, don't quote me on this, but to hold one stock will cost you into the hundreds of thousands. So it's but then you'll have a penny stock that might cost you 5p, or you will have, I know, like say the GS share price at the moment, it can range between 80 to 150 dependent on performance. So it depends on the value of the stock itself and the market cap, so how much of the market share it has, as to if you can own a full stock or not. And obviously the more that you own of the stock, something that I forgot to mention earlier, you have an element of power. So you will have voting rights. So when they have their annual general meetings, or there may be certain corporate actions that they want to do the stock, you may have a say. It may be a little say, because if it's a small percentage, then it's all relative, right? So the more percentage that you have in a company, the more weighting your vote is going to have, but you still have opportunity to voice or choose a certain option dependent on what's going on with that firm.
Okay. As we wrap up then, I guess from like a Christian perspective, what would your perspective be on, we talked about betting, we talked about gambling, and we said like that we're okay with investment, as to summarize in your words, as it being an informed, risk reviewed
whereby you hold something tangible, which would be the product itself. But do you think we have a responsibility to grow our money? Maybe responsibility is too heavy a word, but do you think we're encouraged as Christians to develop in our assets, or do you think we kind of should just kind of stay in our lane? And I definitely, and obviously I'm going to have a biased opinion because obviously what I do and kind of my outlook, but I would definitely encourage people to grow their capital, and even from a Christian perspective, think about some of the great things that we can do across the church, within the community, if you have an increasing capital. Like, I feel that there sometimes is this air of investing is wrong, or chasing money is wrong. As long as you put God first, I feel that he will bless you, and we have the tools, and we have the knowledge and the expertise to increase or gain an increase on what we have. Then I don't see why not. It's the love of money that when it starts to become a problem. But by just consistency and then kind of looking at, we have this life here, and there shouldn't be anything wrong with trying to improve our quality of life, because as I say, with more capital, this provides us the financial freedom to do so much more things which can influence and spread positivity across any endeavors or projects that we want to do. No one wants to be broke, for sure. And I think that, you know, why not say we're Christians and then we're happy and we're devout, but it's also great to be prosperous. I feel that sometimes people think that it always has to be a hard life, but you can be prosperous and still live a very, you know, Christian life, for sure.
With that wisdom of all the things that you talked about, with the research, with the books you've spoken about, with the guidance that's available through financial advisors.
That's it. That's it. Like with the and it's so much easier, and the access to information is just so much more readily available than even 5 to 10 years ago. So why not utilize that to our advantage? Again, heavy caveat, it's not always going to be a great time, and the investment process is one of ups and downs, and that's something that you need to have from a mentality perspective, and be prepared that there's going to be downturns and the market is going to crash like it did at the start of the year. But there's also a recovery phase, and if you manage your risk correctly, then you shouldn't have anything to worry about.
Amazing. Well, thank you so much for joining us, NECYouth. Thank you for your time, for sharing your gifts and your talents and your expertise, though not officially in this capacity. Thank you for giving us your email address, and anyone that would like to get in touch is welcome to, for more specific advice and questions. If we didn't get to your question, sorry about that. And would you mind us praying for us, Jonathan, as we go?
Yeah, sure. Let's bow our heads. Dear Heavenly Father, thank you for bringing us here today. Thank you for the opportunity to speak about investments and how we can utilize these sources at our fingertips to increase and improve our quality of life. I pray that we also remember that it's first and foremost the correct thing to put you first. You are the one that gives us these gifts. You're the one that provides us with these opportunities. Help us to always be faithful to you. And we know that in turn you'll bless us. Be with everyone on the call. Thank you for NECYouth and the ministry that they're doing. I pray that you continue to be with them as they carry on producing content for the young people and others. I pray that you be with us all now and grant us a blessed rest of the week. In your name I pray. Amen.
Amen. Thank you, everybody. Have a great rest of the week.
Thank you, guys.